Hello and welcome. Today, we're going to unlock the language of the financial world. We're going to break down 20 essential English terms that will help you confidently understand what the experts are really talking about. You know that feeling when you're listening to a financial analyst and it sounds like they're speaking a completely different language? Well, stick with me because that's all about to change. We're going to give you the vocabulary you need to follow right along with the pros. All right, so here's our game plan for today. We're going to learn these 20 words by splitting them into 3 simple groups. First, we'll cover words about how money moves around. Then, we'll get into words that describe how the market is thinking and feeling. And finally, we'll look at the tools and signals that analysts use. Ready? Let's get started. Okay, let's jump right into our first section. These first few terms are all about the big picture, where money is flowing in the market and, the reasons why. First up, we have 2 concepts that are basically opposites. On the left, we have defensive sectors. Let's say that slowly. Defensive sectors. One more time. Defensive sectors. These are industries that people need no matter what, like healthcare. They tend to be stable. Now, on the other side, we have cyclical sectors. Say it with me. Cyclical sectors. Again, cyclical sectors. These industries, like car companies, do well when the economy is good, but struggle when it's not. So defensive sectors are steady, while cyclical sectors go up and down with the economy. Okay, so this next term builds right on what we just learned. It's called defensive rotation. Let's see that again, defensive rotation. One more time, defensive rotation. So when you hear about a defensive rotation, it just means investors are getting a bit nervous and moving their money from those risky cyclical stocks into the safer defensive sectors. It's a classic sign of worry in the market. Now for a few really fundamental terms. First, the equity market. Let's say that, equity market. Again, equity market. This is simply another name for the stock market. Next, the commodity market. Say it with me, commodity market. One more time, commodity market. This is where raw materials like oil and gold are traded. And finally, we have risk assets. Let's pronounce it risk assets. Again, risk assets. This is just a general term for investments that can have big gains, but also big losses, like stocks. Great job. We're moving on to our second section. This one is all about market psychology. These words describe the hopes, the fears, and the general mood that drives investors to buy or sell. Our first term here is a really important one. It's the verb phrase pricing in. Say that phrase, pricing in. One more time, pricing in. This is a cool concept. When the market is pricing in some news, it means the reaction has already happened based on expectations. So if everyone expects good news, the price goes up before the announcement. Next, we have 2 ideas that often appear together. First up, complacency. Let's pronounce that, complacency. Again, complacency. Complacency is that feeling when investors get too comfortable and start ignoring risks. And what often follows complacency? Well, that leads us to our next word, repricing. Let's say it, repricing. Again, repricing. A repricing event is basically a reality check, when the market suddenly realizes things are not as safe as they seemed. Here's a fantastic idiom you'll hear a lot, taking in stride. Let's practice that one, taking in stride. One more time, taking in stride. If the market is taking in stride some bad news, it means it's handling it calmly, without a big panic. It shows the market feels pretty confident. All right, our next phrase is a near-term shock. Again, near-term shock. A near-term shock is a sudden, bad event that shakes the market. But, and this is the key part, investors believe the negative effects will be temporary and things will bounce back. And the last word for this section is calibrated. Let's say that, calibrated. One more time, calibrated. This word sounds a bit technical, but it just means something is very carefully measured and adjusted. You'll often hear that central banks are taking a calibrated approach, meaning they're being very cautious and precise. All right, you're doing great. Let's get into our final section. Now, these terms are a little more technical, but don't worry. Think of them as the different gauges on a car's dashboard that analysts are always watching to see what's happening. Let's look at 3 key indicators. First, the VIX. That's V-I-X. Let's just say VIX. Again, VIX. This one is super famous. It's often called the fear index because when the VIX is high, it means investors expect a lot of turbulence ahead. Next up, high yield spreads. Let's break that down. High yield spreads. One more time, high yield spreads. When these spreads get wider, it's another sign of fear in the market. And finally, the yield curve. Let's hear it. Yield curve. Again, yield curve. You'll hear about the yield curve all the time, especially when people are worried about the economy. So, let's connect a few ideas. Imagine a scenario. First, you hear about Fed cuts. Again, Fed cuts. One last time, Fed cuts. This just means the central bank is lowering interest rates. When that happens, some investors might want to monetize their assets. Let's say that word, monetize. Again, monetize. To monetize something means to sell it, to turn it into cash. But for other people, this same situation might look like a buying opportunity. Let's say the phrase, buying opportunity. Again, buying opportunity. A buying opportunity is exactly what it sounds like, a chance to buy things cheap. Here's a great adjective, disorderly. Again, disorderly. When a market is described as disorderly, it's not just that it's going down, it means things are chaotic, volatile, and unpredictable. It's a sign of real panic. Our last technical term is backwards. Say it. Backwards. Again. Backwards. Now, this might sound strange, but in the world of commodities, when a market is backwards, it means the price for getting something right now is higher than the price for getting it in the future. It's a big signal that there's a shortage of that thing right now. And just like that, you've done it. You've learned 20 powerful new financial terms. Seriously, give yourself a pat on the back. You are now so much better equipped to decipher what the experts are actually saying. So let's do a super quick review. We talked about how money moves with terms related to market rotation and sectors. We looked at market psychology with pricing and expectations. And we finished up with the really useful technical tools, the indicators and mechanisms. So here's my challenge to you. The next time you turn on the financial news or read an article, listen for these words. You will be amazed at how much clearer everything becomes. The question isn't just if you can understand them anymore. It's what are you going to do with this new knowledge? Thanks so much for joining me.